Hello everyone, welcome once again to the YouTube platform of Drishti IAS. So we have come with one more video with regard to the series which we have launched on the Drishti YouTube, that is 100 most important topics, and this is for your prelims 2026. That is, the target is for prelims 2026. So in the last class, in the last video, you must have seen with regard to the monetary tools which we discussed, like CRR, SLR and all, and hopefully you must have understood each and everything by reviewing the video again and again. Now in today's video, we have two topics only. One is with regard to the concept regarding Basel I, II and III. That's a quite difficult topic, but we'll try to put it in a very easy format for you. And the second one, it is with regard to the Monetary Policy Committee. So not much with regard to the Monetary Policy Committee, but we will discuss some of the points with regard to it. Okay, so once again, welcome all of you. I'm Girish Venkatesh, and this is your Prelims 2026 target, that is for your economy part. Now, as I said we are going to discuss about Basel I, II and III. Now, first of all, this particular thing, that is the Basel norm. You can call it as the Basel norms, or you can call it as the Basel Accord. Now, when I say the Basel norm or the Basel Accord, basically this Basel norm or the Basel Accord, it is an international banking regulation. And this international banking regulation, what did I say? It's an international banking regulation. And this international banking regulation, it's been issued by none other than BCBS. Now, what is this BCBS? You must all know about it. It's the Basel Committee. Basel Committee on Banking Supervision. Okay, it's the Basel Committee on Banking Supervision. So what happened was that there is an international banking regulation with regard to the risk which the banks face. Now, which type of risk does the banks face? The banks, they face three types of risk. One is the credit risk, the second one is the market risk, and the third one is the operation risk. So the risk is three. One is the credit risk, then the second one is the market risk, and the third one, it's the operation risk. So with regard to that, what happened was that the central bank governors of 10 countries, they met and they established this Basel Accord. And this Basel Accord, it was established 1974. Remember it? It was established 1974. And it's an international banking regulation which is issued by Basel Committee on Banking Supervision. Until 2014 and all, the number of countries which were part of it, it went up till 45. India too is a part of this Basel Accord. Got it? Now, this BCBS, now why this word Basel is being used? Because Basel is one of the places in Switzerland where the BIS is located. Now, what is this BIS? This BIS is nothing else but it is the Bureau of International Settlement. Now, in this Bureau of International Settlement, which is located in Basel, Switzerland, the BCBS office is also situated here. In this particular BIS, the office of the BCBS is also housed. So that's why it's referred as the Basel Norm or the Basel Accord. Now let's jump into the three Basel I, Basel II and Basel III. Now when we talk about the Basel I, what happened was that Basel I, it was introduced in 1988, and the focus of Basel I, it was entirely with regard to mitigating the credit risk. That means the risk with regard to credit. To mitigate that risk, the Basel I was entirely focused on that. And when was it introduced? 1988. Now, when I say credit risk, then what is this credit risk all about? The credit risk is nothing else but it is the possibility of loss. What did I say? It is the possibility of loss resulting from a borrower's failure to repay the loan. That means if there is a borrower, the borrower is not able to repay the loan, then what happens? There is a possibility that the bank is going to incur the loss. So to meet such a situation, that is what is referred as what? Credit risk. That means whenever a borrower fails to pay back the loan, that is the principal amount along with the interest or some other contractual obligations, then what happens is that there is a possibility of loss which the banks will incur, and that is what is referred as what? Credit risk. So, and traditionally also, if you talk about credit risk, then it is nothing else but the lender of the loan. That means one who is giving the loan is the lender of the loan. The lender of the loan is not able to receive. He is not able to receive the owned principal as well as interest. That is what is the credit risk involved. So what happened was that the Basel, it recommended certain, you can say, there were certain recommendations with regard to the banks, with regard to the Basel, you can say, norms. So the first one, as I say you, that there are loans which are given to the customers. Now, how many customers will default, that is not at all sure. But yes, there is a possibility that the customers will, what happen? There are customers who will be in a position not able to return the loans. So when I say banks, the banks, they must have enough capital. Now, why the banks must have enough capital? So that they can meet their, you can say, obligations with regard to the depositors. And also, the banks must have enough capital so as to absorb the unexpected losses. That means banks, every bank, they cannot lend entire amount as the loan. They have to have enough capital with them. Why they want to have enough capital? Because they want to, meet their capital obligation. And the second is that they have to absorb the unexpected losses, that is the credit risk which they can face. Now, how much money is sufficient? That is what is the, you can say, question out here. So what is the Basel I observation? The Basel I observation is that key banks, they give different type of loans to different type of customers. So there are different type of associated risk related to different loans. That means the banks, do they give the same type of loan to everyone? Not at all. So whatever is the nature of the loan, that also differs. Then the customers, they also differ. So when the nature or the type of the loans, they are differing, then the associated risk with every type of loan, that will also be different. Got it? So Basel, what it did was that it came up with one solution. So in this particular slide, what you are seeing is that banks, they have unexpected losses, and for that unexpected losses, they have to have capital with them. And why they have to have capital? So that they can meet their obligations to depositors and also to absorb unexpected losses. Now, how much money they have to have as their capital, that is save capital, that is what is the question. So what happened was that, as I said you, second thing I said, what is the nature of loan? The nature of loan is different to different customers. So the risk associated with every type of loan, that will also be different. So what the Basel I did was that it came up with a categorization. That means what it did was that it categorized the assets as per their risk. That means it gave a 5 categorization of assets. How much categorization? 5 categorization of assets. In category A, there was no risk involved. In category B, there was 10% risk involved. In category C3, there was 20%. In category 4, there was 50%. And in category 5, there is 100% risk involved. That means what they have done is that they have categorized the assets into 5 categories, and they have associated each category of assets with a percentage of risk. That means the category 1 has no percentage of risk, whereas category 5 has 100% of risk. So that is what. Now let us take an example. Like for example, a bank, it can give unsecured loans or it can give what? Secured loans. Now for example, if the bank is giving unsecured loan, that is of rupees 1000, then what is the risk involved? It is category 4 risk. So 50% of 1000 is what? 500 rupees is the risk associated with this unsecured loan. What about the secured loan? The secured loan the bank gave as 4000 rupees. Now because it is secured, though it has comparatively less risk as compared to the unsecured loan. So there is a risk involved here is only 10%. So 4000 ka 10% is what? 400 rupees. So what is this addition? That is the 900 rupees. Now this is the 900 rupees which is the risk involved with regard to these two loans. So this is what is referred as what? Risk weighted asset. That means this particular thing, it is referred as risk weighted asset. Clear everyone? So what the Basel has done is that it has categorized the assets as per what? It has categorized the assets as per the risk involved, and it has given various percentage to each and every category. I tried to explain you with the help of an example that the bank, if it gives an unsecured loan, 50% risk is involved there. So the amount risk associated is 500 rupees, and with regard to the secured, it is only 10%. So the total amount which is at risk for that bank, it is rupees 900. Got it? It is rupees 900. So all of this risk, it is calculated with the help of what? Risk weighted asset, which is called as RWA. What is that? Risk weighted asset, which is called as RWA. So what is the risk weighted asset here? The risk weighted asset is rupees 900. Okay, it is rupees 900. So now what the Basel here one recommended was that a bank has to hold a certain percentage of RWA. That means every bank has to hold a certain percentage of RWA, okay, with them. And that is what is called as CAR. Got it? That is what is called as what? CAR. That is capital adequacy ratio. Got it? This is what? Capital adequacy ratio. Clear? So, RWA is the risk weighted asset, that is the calculation which the banks are doing. Now, a percentage of that RWA, every bank have to keep it with themselves. That is referred as CAR, that is the capital adequacy ratio. Now, how much the banks have to keep? That was decided as 8%. It was decided as what? 8%. And who decided it as 8%? It was the Basel Committee on Banking. Okay? It was the Basel Committee on Banking Supervision, BCBS. It decided that the CAR, which every banks have to keep, that is 8%. And India as a country, it adopted the Basel I in 1999. Remember it? India, it adopted Basel I. India adopted Basel I in 1999. Okay? So, India, it adopted the Basel I in what? 1999. So, what is the CAR? The CAR is the percentage of RWA. Remember it. It is the percentage of RWA which every bank has to keep it with themselves. And that percentage is referred as capital adequacy ratio. And that capital adequacy ratio, it was decided by the BCBS to be 8%, and India adopted it in 1999, that is the 8%. Okay? Now, in India, who is the central bank? In India, the central bank is what? The central bank is the RBI. Now, what the central bank did was that instead of 8%, the central bank asked the banks of India to have a 9% with them. What did the central bank ask the banks of India? To have a 9% with them. And this CAR in India, it is also called as CRAR. Remember it? This CAR, it's also called as CRAR. So, the Basel I norms adopted by India 1999. What was the recommendation of the CAR? It was 8%. Who did the recommendation? It was the BCBS. When it did the recommendation? 1998. And what is this CAR? It is the percentage of RWA which every banks have to keep it with themselves. Okay? And this 9% itself was later on called as MCR, that is minimum capital requirement. Okay, so this 9%, it's referred as what? Minimum capital requirement. So whatever was the 8% decided by the BCBS, India RBI, that is the central bank in India, what it did, it raised 1% and it said that the Indian banks, they have to have 9% as CAR or CRAR. So that is what is also referred as what? Minimum capital requirement. I saw everything is clear to you. Okay? Minimum capital requirement. Now this minimum capital requirement then gets divided into two tiers. Now this minimum capital requirement, it gets divided into what? Two tiers. And tier 1 and then there is the tier 2. So the banks, they have to have what? Minimum capital requirement. And this minimum capital requirement gets divided into two tiers, tier 1 and tier 2. Tier 1 refers to what? Tier 1 refers to that the banks, it can absorb losses without a bank stopping its functioning. Tier 1 is that the banks can absorb losses, but the bank's operation will not stop. The banks will continue to function. Like for example, you have a car, and in front of that car there is a you can say there is a protector, the iron protector with regard to that. Now what happens that you crash that car, someone hits in the front, so that is got damaged, but still your car will go. So that is what is happening, that in spite of the losses, your bank is able to absorb those losses and the bank is able to continue with the functioning. So the bank is not stopping its functioning. That is tier 1. And tier 2 capital is what? It can absorb losses in the event of winding up. That means the bank will wind up. Wind up means the bank will shut down. That means the same car, you had an accident, and what it did was that it hit so hard that inside the car there were airbags, and those airbags came up. So when the airbags came up, the car is not going to function on its own. How the car will be moved from there? There is a towing van which is required for the car to move. So that is what is tier 2. So the tier 2 is that all the losses have been absorbed, and how the losses have been absorbed? After winding up the bank. So these are the tier 1 and tier 2. And according to the you can say RBI, debt absorption capacity of tier 1 capital is more than tier 2 capital. Tier 1 capital debt absorption capacity, it is more than tier 2. And what RBI does is that the RBI, when it tries to assess the financial strength of a bank, when it is trying to assess the financial strength of a bank, it always moves on with the tier 1 and tier 2. So it looks into the tier 1 and tier 2 capital of that bank, and according to that, it tries to assess what is the financial strength of the bank. Now, when I talk about tier 1, now why tier 1 capital is more than tier 2 capital? Absorption capacity of tier 1, why it is more than the tier 2? Because tier 1 capital, it is more reliable, it is more liquid. It is more reliable as well as more liquid. And what are the capital which are, what are the part of that tier 1 capital? Number 1, it can be stockholders' equity. Number 2, it can be disclosed reserved. And number 3, it can be the statutory liquidity ratio assets. And number 4, it can be the total liquid cash. So the tier 1, it includes, again I'm saying, stockholders' equity, disclosed reserves, that means those reserves which the banks have disclosed, statutory liquidity ratio assets, that can be in the form of GSEC, cash or gold, and third is the total liquid cash. And this tier 1, it is highly reliable and it is highly liquid. Now what about tier 2? Tier 2, it has undisclosed reserves. Undisclosed reserves means those reserves which are hidden, which are not shown in the account books, which are not shown in the account books, which are hidden. So that is what is undisclosed reserves. Then the second one is retained earning. That means after the bank gives the shareholders the dividends, then whatever is left, that is only the retained earning. So the second one is the retained earning. And the third one is the fixed assets. For example, the building which the bank has, the car which the bank has, the ATMs which the bank has, the typewriters which the bank has. So all the fixed assets which the bank have, that form a part of tier 2. So what happens? when you are selling all of this to absorb your loss, it means that you have to wind up. It means that you have to wind up. So this tier 2, the losses are absorbed by winding up. That means all the undisclosed reserves, all the fixed assets and all the retained earnings, they all are gone. But that's why it says that debt absorption capacity of tier 1 capital is more than the tier 2. So that is what I'm saying here. Ki tier 1, it involves undisclosed reserves, retained earnings and fixed assets. And tier 2, it consists of financial capital which is considered more reliable and more liquid. That is stockholders' equity, disclosed reserve, SLR assets and total liquid cash. So RBI what it does, the financial strength, it's based on the tier 1 and tier 2 capital. Is it clear to all of you? So this is what is happening in the Basel I. But in Basel I, as I said you, how many risks were there involved with the banks? One was the credit risk, the second was the market risk, and the third one, it was what? It was the operation risk. So in Basel I, what happened was that the credit risk was somewhat solved, but still the other two risks, that is the market risk as well as you can say the operational risk, they were still not catered to. They were still not mitigated. So what the banks did was that it came up with Basel II, and that Basel II, it was published in the year 2004, and the banks thought that, that is the Basel Accord, it thought that instead of one pillar, two more pillars have to be added so that it can give stability, it can give more strength to the banks. So the Basel II Accord, it added two more pillars, and now we can say that these two more pillars, one was, as I said you, one pillar is there already. So here you can see that two more pillars are added, and the one pillar is supervisory review and the second pillar is what? Market discipline. And this Basel II, as I said you, when what is it published? It was published in the year 2004. Remember it. And already the first you can say pillar is there. And this first pillar is what? Minimum capital requirement. And what is this minimum capital requirement? 8% of the RWA. 8% of the RWA. And this minimum capital requirement, it had tier 1 and it had tier 2, and tier 1 was like 4%. For example, if it was 4% of the RWA, then the rest was in tier 2 capital, that is another 4. But it was like 4% or 4.5%. So if it is 4.5, now you can understand it more clearly, that if out of this 8%, if 4.5% is for tier 1, then the rest 3.5% will be for tier 2. So in Basel II, what is happening? In Basel II, with regard to strengthening the situation of the banks, two more pillars are added. One is the supervisory review and the other one is the market discipline. Supervisory review is nothing else, but here the focus was on banks' internal processes and system. That means, what is the bank's internal process? What will be the bank's internal system? That was focused on. And market discipline mein, the banks, they had to disclose the requirements. That means disclose whatever reserves are there. So as a result, this enhanced what? Transparency. So now there are how many pillars? 3 pillars. You can see here there are 3 pillars. First pillar in the middle, which was added by the Basel I, that is the minimum capital requirement. And the other 2 pillars, they are added by the Basel II, which was published in the year 2004. Okay, which was published in the year 2004. Okay, so now still there is a minimum limit for the base tier 1, and for example if it is 4.5% of the RWA, and what was the RWA which was decided? It was 8%. So out of the remaining 8%, 3.5% is for tier 2. But still, what happened in spite of all this? We could see that in the year 2008, many of the banks in the world, they collapsed. There was a time when in 2008 we could see that the banks, they were functioning stably, but there was a situation like many of the banks, they collapsed. And because they collapsed, then what came? The Basel III came. What came? The Basel III came. Now this Basel III, it was introduced. Now in this Basel III, the three pillars are there. These three pillars, they are there. But apart from that, what was introduced? CAR, LCR, NSFR, CCCB and CCB. So that means these three pillars are there, but apart from that, these things were added with the banks. Now one by one, let us say what is this. Now for example, what is this CAR? CAR is something which the banks have to hold. For example, earlier it was like 4.5%. So now in tier 1, it was raised to 6%. That means 6% of the CAR. 6% of the CAR means earlier CAR was how much? 8%. That was increased to how much? 9.5%. So 6% has to be held by the tier 1 capital, and rest is to be there for tier 2. Now what is this tier 3? Tier 3 is nothing else but it will supplement tier 1 and tier 2. Tier 3, it will supplement tier 1 and 2. Okay, so one more tier is added, and that is the tier 3, and the tier 3, it will supplement tier 1 and tier 2. Got it? Tier 1 and tier 2. And the CAR, it was now 9.5%, and the tier 1 capital, that was raised to 6%. Okay. Then the second one is LCR. LCR means what? Liquidity coverage ratio. Now what is this liquidity coverage ratio? Liquidity coverage ratio is like, for example, your bank is in urgent, you can say there is a very emergency situation, and what happens is that your it's in a very bad situation, and it is in a crisis situation. So LCR is that deposit which can handle the operations of the bank till 30 days. So you have to remember this. LCR is that deposit which the banks have so that the bank can run for the coming 30 days. And how the LCR is calculated? And LCR are what? High quality liquidity assets, so as to survive an acute stress scenario lasting 30 days. And this LCR, because here the word ratio is used, and this ratio means it has to be in percentage. Remember here, it is a ratio, so it has to be in percentage. And how the percentage is calculated? High quality liquid assets divided by the total net cash flow. That means what is the cash flow going to happen in those 30 days? That total net cash flow into 100%. That means whatever is the total net cash flow in those 30 days, that is being divided by the HQLAs into 100. So this liquidity coverage ratio, it's for handling the coming 30 days. Then the third one, it is NSFR. Now NSFR is nothing else but it is net stable funding ratio. Now that was for 30 days. Now this is for what? 1 year. So how the banks in a crisis situation can run for 1 year, that is the amount which every bank has to put in the name of NSFR. N stands for net stable funding ratio, and in this this is also a ratio. So the percentage of money which is being put, that is to run the bank for 1 year. So it is a reliable source of finance which can fund bank activities for medium term resilience. Okay. Then comes the CCCB, that is the counter cyclical capital buffer. Now this counter cyclical capital buffer, what it can do, it can add capital, it can take out capital. Add capital means whenever there is excess credit, then it can add capital to this. This is the CCCB. So it can add capital to it, and whenever the banks are in stress, they can take out the capital. So CCCB, you can pause the video and you can write it down, that it is determined and set by the National Regulatory Authority based on their assessment. And this buffer ratio, it is nothing else but it is the amount which the banks have. They can take out when there is a stress period, they can add to the capital when they have excessive credit growth. And the final thing is the capital conservation buffer, which is 2.5% of the RWA. So these are the 5 things which were added to the Basel II. So from this we can understand that there is Basel I, there is Basel II, there is Basel III, and there is what? Basel IV, Basel III. So this is what is there with regard to Basel I, II, and III. I guess everything is clear. Okay? Final. So now you must all understand these things. What you have to do, you have to just pause the video and please, this is the thing which was added in Basel III. That means now every banks, they have to have these things. They have to have these things. This is CAR, that means tier 1 was increased. This is LCR, that is for 30 days. This is for 1 year. This is something where the banks can add, where the banks can take out. And this is the 2.5% of the RWA. Okay. Now, the second topic which I wanted to discuss here was with regard to the Monetary Policy Committee. But first of all, let's talk about something which is regarded as economic growth. Now take for example our country India. Now in India, one of the main reasons when economic growth will take place, it is only because when there is price stability. And price stability means when the inflation is under control. Now who is controlling the inflation? It is the RBI which will control the inflation. That means, what did I say? I said that India has to have economic growth. For economic growth, there needs to be price stability. Price stability means inflation has to be in check. And how the inflation can be in check? It is the RBI which takes steps for having the inflation in check. But inflation, it depends upon what? It depends upon demand. That means when there is too much of demand, excess of demand, prices will rise. And why there is excess of demand? Because people, they have more purchasing power. That means the purchasing power in our country, it is more. So whatever we demand, it depends upon the purchasing power. And that purchasing power, it depends upon your liquid money. Remember it, there are 2 types of money. One money is the liquid money which you have in your pocket, which you can spend. There is no restriction for you to spend it. So that is what is liquid money. And your purchasing power depends upon your liquid money. For example, I have a 5 crore asset. For example, I have a 5 crore house. But the other day, I thought of buying a jet plane which worth 30 lakh rupees. So now can I buy the jet plane? No, because I don't have liquid cash. Yes, I have a blocked money, and that blocked money is the 5 crore house which I own. So if I want to buy the jet plane worth 30 lakhs, I have to sell my house. Now for selling the house and everything, it would take like 2 or 3 months. So in that 2 or 3 months, will the seller of that jet plane stop for me? No. So what happens is that my purchasing power is not there. So my purchasing power, it depends upon the liquid money. So money is of two types. One is liquid money, which is there in your pocket in cash, and the other one is your blocked money. The blocked money can be in the form of house, car, and something like fixed deposit. It can be in the form of provident funds. It can be in the form of pension, many such things, time deposits के form में. So that is what is called as blocked money. Now blocked money does not lead to inflation, but it is the liquid money by which your purchasing power rises. And because your purchasing power is rising, then what happens is that you will demand more, and when you demand more, so what happens is that the prices will go up, and when the prices go up, then that is what is referred as what? Inflation. Got it? That is what is referred as what? Inflation. Now, as I said you, this inflation, is it good for the country? Now, what happens is that when there is a steady inflation, that is good. But here, the RBI, it has to control the inflation. Now, for the RBI to control the inflation, there are what? The RBI comes up with the monetary policy. What did the RBI come up? The RBI come up with the monetary policy. Now let me show you the monetary policy which the RBI comes up with. Now the RBI, the monetary policy, it can be qualitative, it can be quantitative. Now the quantitative, it affects the prices directly, and qualitative, it affects indirectly. Quantitative are what? The RBI, it directly affects the supply of liquid money. Now CRR is one of them, open market operations is one of them, SLR, repo rate, reserve repo rate, MSF, bank rate, these are there. And what about the qualitative? That affects indirectly the supply of liquid money, and that is credit ceiling, moral suasion, direct lending, credit guidance. So these are the monetary policy, that is the qualitative and the quantitative measures which the RBI will take so as to control the supply of money in the market. Got it? Now, this monetary policy, it is being made by none other than the Monetary Policy Committee. Got it? By none other than the Monetary Policy Committee. Now, when I talk about the Monetary Policy Committee, February, there was a meeting which was held with regard to the Monetary Policy Committee. That is 4th to 6th February 2026, the meeting was held with regard to the Monetary Policy Committee. And this was the 59th meeting of the Monetary Policy Committee. The next meeting of the Monetary Policy Committee is scheduled in the month of April 6 to 8, 2026. So remember that there is a Monetary Policy Committee. The Monetary Policy Committee has how many members? 6 members. 3 of the members, remember it, 6 members they have. 3 of the members are from the RBI. 3 of the members are from the RBI. One of them is the RBI governor himself. So RBI governor is what? RBI governor is the chairperson of the Monetary Committee. The other member of the Monetary Committee is the deputy governor of the RBI. And the other member is an RBI official who is nominated by the RBI governor. So there are 3 members. And the rest 3 members, they are from the Ministry of Finance. So the monetary policy is controlled by the RBI, and there is a monetary policy committee which is being formed. That is, alone the RBI governor cannot do anything. It is the monetary policy committee which takes the decision with regard to all the rates, whether it is repo rate, anything with regard to that. And in this monetary policy committee, 3 members are from the RBI, 3 members are from the Ministry of Finance, and the chairman of this monetary policy committee is none other than the governor, and that means present governor of the RBI. Now, there is a surprise question for all of you. First question is that who is the present governor of the RBI and who were the other members? That means other five members. Who were the other 5 members of the monetary policy committee which met in the month of February 2026? That is the question for you. Who were the other members? Okay, who were the other members? And please remember, there was a recommendation by the monetary policy committee. Now, when it comes to the repo rate, they said that no change, 5.25%, SDF no change, 5%, MSF no change, 5.50%, then bank rate no change, 5.50%, monetary policy stance. Now, the monetary policy stance, they said that it should be neutral. What? Monetary policy stance, they said that it should be neutral. But among those 5 members, there was one member who said that no, it should not be neutral. Rather, it should be accommodative. Now, who was that member? I will name it to you. He was none other than Ram Singh. He was none other than Professor Ram Singh. So the other members, they were happy with the neutral stance, but Professor Ram Singh said that no, it should be accommodative instead of neutral. So this can be a question in your prelims 2026, that who was the member of that monetary policy committee who had a different view with regard to the monetary policy stance. Okay, but still the monetary policy stance is what? Neutral. So this is what is the monetary policy committee which you have to remember. And I said you that this is something which is with regard to the inflation and all. So today's video, it had Basel I, Basel II, Basel III, and the second part was with regard to the monetary policy committee. And why that monetary policy committee comes? Because to have monetary policies, that is the quantitative and the qualitative measures में जो भी rates है उसको yes it decides. So thank you all. Hopefully this particular video must have helped you a lot, and if you are facing any doubts, please write it on the comment box, and please share this video to as much students as you know who are appearing for the prelims 2026. So we'll come up with the 4th video with some more topics with regard to the banking side. And please remember the surprise question which I gave you today. Thank you. See you in the next video.
For more informative content, like, share and subscribe, and do not forget to press the bell icon to get the notifications.